Hi, welcome back. This is the third chapter where we look at payments, part of the Fintech wheel of disruption. Remember the WEF wheel of disruption. What are we talking about? We're over here, remember, and we're looking at emerging payment rails and the cashless world. Let's get into this and start disrupting. There we go. Now, if we look at the payments ecosystem, there are 6 areas in which startups around the world are trying to disrupt payments, which was the domain of the banking system. Acquirers and processors, there are the card networks and issuers, gateways, the ISOs, and non-card payments. Notice in the first chapter, we talked about Capital One as that example where it came from nothing to be the dominant credit card company in the world. Well, Capital One is over here. If we go, oh, I cannot, my hand cannot go across, it gets cut off. But it's about here. We're talking about issuers in the second column. That's where Capital One is. So what is it about this taking over of all of these 6 areas of the payments ecosystem by startups around the world? Well, traditionally, the banks have made money in the current system under credit cards, initiation of direct debit credit transfers, checking, cash, and wire transfers. They make oodles of money out in these areas. Now, I want you to go back about 4-5 decades when the whole idea, if I want to give you money, a large sum of money, I wouldn't give you cash, but I would write a check. And many of you probably haven't seen a check, but it's basically a piece of paper with the bank and a special ISBN number for the bank and everything on the bottom of it. And then you sign. You give that to your friend as a payment. The friend will take it to their bank account and deposit it. And then the bank will, through its back office operations, will clear that check with my bank in the next 24 hours. Or in the old days, it took many, many days. And when it comes to my bank will actually check my signature against the signature they have on record. And then suddenly a payment is being transferred and the money goes out of my account. That's the old system. Now, you're probably wondering, does that system still exist today? Yes, it does, in many countries. Even in Hong Kong, today, I have checkbooks for my bank accounts in Hong Kong that I could write checks and give to people. That is still in operation today. That is the clearing system. It requires a clearinghouse. Like we call that a middle person, a middleman, a middle person. And this is a key area that the fintech startups are attempting to disrupt. Now, what other services are being provided by the middleman? Not only lending, there's holding money, moving money, trading money, but also how do they make money out of all of these different services? Well, they net out the interest. They lend money at one level, but they borrow money, your deposits, at a lower level, and then they keep the difference. There is income that banks earn from that. There are fees that they charge you when you have to do a certain transfer overseas, or you have to do, if you've got no money in your bank account and then there's an automatic payment goes against it, they may charge you a fee. They may charge you a monthly fee if you don't have enough money in your monthly account. Then there's the float that they make money on, and then there's interest that they make money on. What other areas? Well, the wire transfers tends to be the largest area where banks are making a lot of money. The fees, the spreads are huge. And Western Union is a big financial institution in this game. All of the people in this Asian region send money, remittances back to their families, generally through Western Union, tends to dominate this area. What do we mean by how they make big money? Well, often if I want to send $500 to the Philippines, to India, to Vietnam, to my family if they live there, then Western Union is going to take a lot of money. They could take 5%, 6% or more. What do we mean? Do we have more information on this? Well, in terms of the world's top remittance recipients, India, China, Mexico, and Philippines. Now, look at this. I've taken details, if you have a look right here, of the actual transfer costs. If I want to send $1,000 to China, then that's going to cost me $20 in a transfer fee. Okay, so that's 2%. All right, and it gets lower and lower if I send more. But if I want to send that same amount at 1,000 to India, they're going to charge me $12.50, and then maybe that's 1.2%. But what about the Philippines? It could be, there's a lot, 5.90, 5.9. And so you can see that the transfer fees, they make a lot of money from sending these transfers. Now, most people don't even send $1,000. They're sending money in lots of $100. And so you can see that the interest rate gets higher and higher and higher as you send less and less each time. And not everyone just has $1,000 to send or wait to get $1,000. They may be just sending $100 every other week. And so you can see that these fees can be ginormous. You can see selling to the Philippines, $100, $4.90 as a fee if I wait a few days, or $6.90 as a fee if I want it done immediately. Then that's 6.9% on $100. So you can see that Western Union is making a lot of money on remittances. So payments, remittances across countries is the biggest opportunity to be disrupted by fintech companies. What other trends are there? Cards are growing faster than checks. Mobile wallets are growing very, very fast, especially in Asia. And you can see here from 2015 all the way to 2025, you can see the amount of millions going into through mobile wallets, and especially dominated by China, India, and Japan, and then followed by South Korea and Australia. You can see that Southeast Asia, South Asia is really, really big in the take-up of mobile wallets. What other trends are there in mobile wallets? Well, China style, we know Alipay, we know WeChat Pay, Union Pay. They are ginormous institutions in terms of accessibility in China. When you want to go to China, it's best that you do have Alipay or WeChat Pay and not just rely on cash, because you'll go to the restaurants where they won't take cash, even though it is against the law, but that's the way it is in China and different places. Mobile wallets, as you can see, the mobile payment adoption in China beats all others. South Korea, Vietnam, Norway, UK, India. You can see the annual transaction value per user, you're talking $2,300. The penetration rate is huge compared to more developed countries like the UK, US, Germany, and Italy, over double. But here's the one thing that you need to take away, and that is the middleman is still in existence. When I set up my mobile wallet, it actually still goes through a middleman to the merchant that I'm paying. In the end, it goes to the merchant's bank account. So the bank is still part of the puzzle. And you can see that there's a lot of disruptions for the last century, but the middleman has always been in these disruptions. The middleman has not been disrupted directly. The middleman is still there. This is not disruptive innovation when the middleman is still there. In other words, if we take out the middleman, then we should only have the card holder and the merchant. But we still have the issuer, that is Visa, MasterCard, all right, and the acquirer on the other side, helping to do the settlement of the funds when you do a transaction through your mobile wallet, through your credit card, or through some other financial device. They're still using the same pipes, the middleman, the clearinghouse. But now, what has changed? With the emergence of fintech startups, companies, as I explained in chapter 1, companies are starting to collect data. And they start to see you as an account as a consumer as a data point. We can collect data on you that enables us to serve you better and give you products that fit your needs. Just like what Capital One did when it collected your data beyond what the FICO score told them about you as your ability to repay. We got more data on you, so then we can give a much more tailored service to you, whether that be a loan, whether that be insurance, whether that be something else. But the real disruption, the money stays within the payment firm system. And that's what PayPal is trying to do. PayPal is from one end to the other. PayPal is trying to be the place where it's provided the merchant the service, but it's at the other end also managing your money and not giving your money to the bank account. If you have a PayPal, you have the option of leaving your money in deposit with PayPal and not asking PayPal to pay it back to you through your account, through your credit card. Wow. So PayPal is trying to be the middleman, but also at the retail end and also at the banking end as well. Wow. What other type of disruption? So the first type, we could say that the disruption is trying to keep your money in the system. The second type is collecting your data so I can make better decisions about services to sell to you, whether they're loan services, insurance services. What else? Collecting data again in terms of giving services on wealth management, financing, insurance, credit rating, your history. Alibaba has all of this information on you if you are a client of Alibaba. If you are using Alibaba's platform, they get all this information and then they can actually use that to provide better services. So that's a perfect example of how things have evolved just in the last decade. But the third area where they're trying to make inroads, that is the fintechs, supported by VC capital, are trying to make inroads into the banking system, is by undercutting the general merchant fees that the traditional banks have been charging. So traditional merchants are charging 300 basis points, meaning 3% interest. Whereas now you've got these fintech startups coming in and saying that, well, WeChat and Alipay, we're just going to charge 60 basis points. China bank cards are charging 65 basis points. The USA debit card is charging around that amount. What does that mean? That's about 0.65%, not 3% on your transaction. And that's a big disruption. So we've got disruptions going on in terms of holding your money, in terms of collecting your data, and also in actually driving down merchant fees. So because the traditional banks, the credit cards, were charging 3% or more to the merchants, it's easy for GrabPay to go in and say, how about you set us up as a wallet with Mr. and Mrs. Merchant, and we'll only charge you 2% or 1%. That's how fintechs are making inroads into the financial ecosystem. Now, the fourth area is when we have full disintermediation. That is, we get rid of the middleman and we throw the middleman away. How can we do that? Well, we need some kind of trusting mechanism like blockchain. And with the blockchain as a foundation, we have the emergence of Bitcoin. And Bitcoin is a great example of how we are disintermediation of the traditional financial institutions who are connected by a clearinghouse. And with Bitcoin, we're going to talk about that shortly, under blockchain, well then we can actually overcome all of these different parts in the system, because Bitcoin has end-to-end provenance over the ownership of the money, the transference of the money, and the transference of the ownership. It doesn't need any other party to do that because the blockchain and its consensus algorithm does that for you. Wow. All right, so this is what we mean by blockchain, and we can talk more about that in other areas. But for now, so I just want to summarize how we are disrupting this landscape. Number one, we are keeping your money and you're not asking for it to be paid back to your bank account, just like what PayPal is doing. Number two, we're collecting your data and using that data to give you finely tuned services that you appreciate. Number three, we are also charging lower merchant fees. Therefore, we are gaining more customers than the traditional banks have, and we're actually growing a greater foothold in the financial market. And number four, we have full disintermediation, like Bitcoin as the perfect example, where the consensus algorithm is actually taken over the role of the clearinghouse in trusting the transfer of wealth from me to another party and the ownership that goes with that. Wow. Now, let's have a look at, in a little bit more detail, about Bitcoin. How big is it and how real is it? As we can see here, there's been the march of financial services into Bitcoin and blockchain startups. And look at them all here. And you can see this has started many, many years ago, about 7 years ago. And it's continuing on, 2017, but also 18, 19, 20, 21. And a lot more banks are getting involved in this space now. Wow. Now, what do we mean by the value of Bitcoin? How big and how real is it? Well, as you can see here, the top graph here, you can see that this is the whole pricing of Bitcoin over the last decade, if you will. All right, it came from basically nothing to a high of 68,000 back in 2021. Even in the last 6 months, as you can see here, it did get up to 68,000, but it soon come back down. What does that mean? It might mean something, but it depends on the reason why you might hold Bitcoin. We'll talk about that shortly. But payments, again, is the biggest opportunity for cryptocurrencies like Bitcoin, because the average cost remitting from the G20 countries is, as you can see here, 4, 5, 6, 7, 8%. The example I showed you earlier, we had just 1% or 2%. Remember, they were for large amounts, but a lot of remittances are much lower than that, and that's why the percentages are much higher. The other thing is that we're trying to disrupt with cryptocurrencies, Bitcoin, are the correspondent bank relationship. Because when I send money to someone in another country, through electronically, my bank has to communicate to a corresponding bank in this country, like Malaysia, and then that corresponding bank will talk to their corresponding banking network in the other country I'm sending to, like Australia, and then that will connect with the other bank of the person I'm sending money to. And because of all those connections, they've got to get their little charge and get their piece of the pie. But what about the unbanked? And this is where Bitcoin startups are targeting the world's 2.5 billion unbanked population. And the idea is that, well, if you don't have a bank, how do you actually gain access to wealth? How do you actually gain access to a trading relationship where you are giving a good for the receipt of money? It is very hard to go outside the cash system. It's very hard to go outside your own village or region or country if you're just working with cash. And that's the problem of the unbanked. Well, Bitcoin startups are trying to change that by having various startups and allowing you to transfer Bitcoin from you to someone else in another country without that fee being charged by a corresponding bank. So you can see that there's possibility to help the unbanked with Bitcoin startups, but the fees are not necessarily cheap as well, and they could go as far as 5, 6, 7, 8, 9%, depending on how much you are sending to someone else in the Bitcoin network, or the blockchain is the actual computer side of the network, Bitcoin being the currency on the blockchain. Wow. So let's just pause for a moment. And we've been talking about Bitcoin and how it has grown, and as you can see here, like the market cap of Bitcoin over 1.07 trillion, and that was October 2021. Like, it's ginormous and far outweighs any other bank like JP Morgan. Ethereum is another cryptocurrency, but Bank of America, ICBC, etc. So you can see that Bitcoin has grown large. So the big question now we want to think about is, well, what is Bitcoin? Is Bitcoin money? And then to answer that question, we need to think, okay, what are the principles that underlie what is money? So let's just have a look at them in this final section of this chapter. So let's shine a light on Bitcoin in terms of these three areas. First of all, as a store of value, yes, Bitcoin has made you a lot of money. If you go from 2016 to 2017, it's gone from next to nothing up to 19,000. But then it went all the way down to 3,000 and then back up to 68,000. It's like a roller coaster. And now it's back down to 38,000, even less as we speak this month in 2022. All right, so it may be a store of value depending on when you bought it. Okay, there's the transfer volume. Obviously, there's a lot of volume going into Bitcoin to actually help to propel and sustain its role as a store of value. But it is still quite volatile. And that's something that people are increasingly aware of. Asset managers are increasingly aware of, and they are advising that if you want to hold Bitcoin, it should only be a teeny weeny little part of your portfolio and not be the majority part of your portfolio. All right, what about Bitcoin as a unit of account? What does that mean? Well, as a unit of account, we need to be able to state the economic balance sheet or the profit and loss of a company in terms of their financial accounts at the end of each quarter, at the end of each year, the annual report. You are all financial people. You're studying finance, but many of you are studying also accounting. And we have to account for the economic activity in the organization. If we start using Bitcoin, then there's going to be a tremendous volatility in the communication of the annual report versus if we're using a stable coin, a stable currency like the US dollar, or the euro, or the pound, or the Australian dollar, or the Malaysian ringgit for that matter. So the unit of account, really, the Bitcoin is not a good unit of account because it is so volatile. All right, what about as a medium of exchange? You can see that the price of gasoline, if we put it in US dollars, it just goes a little bit over time. But look at the price of oil or gasoline in terms of Bitcoins per gallon, and you can see it just ginormous and then all the way down. So it's a bit hard to actually keep Bitcoin as a medium of exchange. The prices will be changing every day. You'd need a calculator every time you go to the shop, every time you go to the market, every time you go to the supermarket. It'd be crazy. You couldn't use it as a medium of exchange. So I want you to think about this, that Bitcoin, great, it's moving along and more money is being piled into it, but is it really a store of value, a unit of account, or a medium of exchange? Maybe some of you could think it's a store of value. Very hard for it to be a unit of account, and very difficult because of its volatility to be a medium of exchange. Again, volatility again, you can see just ginormous percentage moves over the last two years. Like, that's just January 19 to April 2020, and it's even worse since then. Okay, now let's have a look at the cost of Bitcoin. Like, nothing is free in this world. And what is the cost of Bitcoin? Like, you no longer have banks or clearing houses. You don't need to pay people to clear the transaction when I give you Bitcoin and take some physical good in return, like a pizza. Then, well, we don't need a clearinghouse. We don't need a bank. We don't need PayPal. We don't need Alibaba. We don't need anyone in the middle. So you probably think, well, there's no cost, right? Yes, there is cost. The cost is in the consensus algorithm that is needed to create a trusting platform. So when I transfer the property rights of my Bitcoin ownership over to you, then I can be assured that you have received that ownership from me. And then we can secure the transaction and get back the services from you or the physical good that you're going to give to me. Now there is a cost, and that is the energy. We need miners around the world, and as of the last calculations, about 8, 9, 10,000 miners. That is people with a computer mining for Bitcoin, mining for the next block in the blockchain. And that's part of the consensus algorithm upon which Bitcoin is based. So those miners use power. And that power generation, if you look at just 2 years ago, it ranked Bitcoin, all of these 10,000 miners around the world, ranked between Austria and Czechia and Switzerland. Wow. 2 years later, it's 125. It's actually doubled. And now Bitcoin ranks between Poland, Egypt, Ukraine, and Norway. Wow. It's using up a huge slab of energy. Wow. So we don't have to pay for banks, buildings, and lights for the clearinghouse, but now we have to pay for miners. And so you can go figure, is it really worth the energy to actually create this consensus algorithm upon which Bitcoin is based? That's a good question. Okay, so what is the cost of Bitcoin in terms of transaction fees? Well, here's a graph that shows that the cost of sending Bitcoin across countries through the different payment rails can be as much as $3, $4, $5, $6 US. So that may be not much if you're sending 10,000 US dollars of Bitcoin, but what if you're just sending 100 or 200 US dollars? Then this is quite a lot. And as you can see, the Bitcoin spreads, the buy and sell, you can see 5%. And if we look at some of the other platforms, payment rails that allow you to exchange Bitcoin, the buy-sell spread is upwards of 10%. So depending on how efficient the on-ramp and off-ramp payment rails are, that is the startups and the platforms that enable you to transfer your ownership of blockchain, Bitcoin, to another person, then you are susceptible to what the platform is charging. Okay, yes, you can go to Bloomberg and find out the Bitcoin price, but when you go to Coinbase platform to send Bitcoin to someone else, you've got to work with the bid and ask spread that Coinbase has set for the platform on any particular day. And that spread could be as much as 5% difference or 10% difference. Wow. So the Bitcoin on average is about 8%, 9%. And maybe if you are remitting 10,000, 50,000 US dollars, then the percentage can go down. Okay, you have volume benefits. Wow. So look at how the ordinary payment systems may survive. The only way that they can survive is likely to just have smaller and smaller margin. So therefore, that's why they will remain competitive, because Bitcoin, even though it moves away from the clearinghouse mechanism, still has larger margins in the bid-ask spread than the ordinary clearinghouse-based payment rails. But what about in B2B payments? There is a big opportunity for cryptocurrencies, Bitcoin, to be used in B2B payments to support supply chains, to support the payments between businesses rather than C2C payments between consumers. And as you can see here, B2B supplier payments amount to US dollar $15 trillion. And this is going back several years ago. It's even more today. Okay, so that finishes my chapter 3 on payments. And the next chapter, market provisioning, I will go back to a previous video recording that I have made and leave it for you to digest and to ask questions on in class. This is O'Connor. Thank you for diving into payments with me. It has been an amazing journey to have a look at how startups are disrupting the traditional financial services sector and trying to throw the middleman away and actually disrupting the margins that are charged and also interest rates that are charged, as well as the data access that they are bringing, and ultimately throwing an intermediary away with the advent of using Bitcoin as a payment mechanism. Wow, this is an amazing area, amazing growth area, especially in this area of the world. Stay tuned for the next chapter of Fintech, the last part of the WEF Wheel of Disruption. This is O'Connor, and see you in class. Bye for now.